So about 10% of the Russell 1000 index has reported earnings so far this season. I think that's probably enough that we can begin to see what's going on with that as a representative sample. So we're going to talk about some of those earnings and some other things today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. So on my screen right now, what I am showing is, what I was showing, the earnings that we have seen so far. So of the 988 companies that are slated to report earnings between April 1st and July 1st, so that's kind of a custom range that I've selected. If I just use Bloomberg's defaults, what they consider the earnings season doesn't completely jive with the way I think most of us think about it. How do most of us think about it? We usually think about it the way the year is broken up into quarters, so January to March, April to June, and so on. Technically, it depends. I guess some people have different views of what the first name to report for the earnings season is. For me, I usually think of Delta. The big one would be JP Morgan. And Delta, which we were actually talking about with Mark Guthner on Office Hours, which you didn't happen to check it out. You can see the recorded version on the website from yesterday. Delta Airlines. So I decided to just sort of take a look and say, okay, well, how are companies doing overall? So we've got 105 companies within the Russell 1000 index that have reported since April 1st. There are 988 of the index that are slated to report for the 3 months that represent basically the second quarter of 2026. And here's what we can see. So we're going to look first at the sales and earnings surprises, and then we're going to take a look at the sales and earnings growth. And then we're going to take a look at how a couple of these performed. And actually, what I'm going to quickly do over here on another screen, because I forgot to do it, and you would think from all of these that we've done, is bring up the part where you guys get to ask your questions in the chat. So if anybody is watching this on X, unfortunately, we don't have a mechanism to pull your questions onto the screen. So if you want to do that, you have to put your comments or questions into the live chat on the YouTube channel. Otherwise, if you're just here to listen and observe, it won't make any difference. Okay, so as we take a look at this, one of the things we can see is that on balance, we are seeing positive surprises, if fairly modest ones, on the sales side across several sectors. Consumer discretionary, and perhaps this isn't really that surprising, is the one that was the weakest. That one is right over here. And we can see that it was just a 36 basis point beat. As we look at this, we can see that there were 8 that came out with a positive sales surprise. We had, a handful that were essentially in line, and then we also have a couple disappointments here. This is probably not that surprising as we think about it. Not going to be a profound impact because the first strikes took place 2/3 of the way through that first quarter, but it is going to end up having an impact. So if we want, we can actually take a look at what some of these companies were. So I can do that by just selecting that sector. And then we can look at all the securities and see what they were. And actually it was 8, now 9 companies. So we must have just had one just report after the close today. And perhaps we can even do this. We will sort best to worst. And I suppose, again, maybe not terribly surprising. And this was actually the surprise to me. This is actually what prompted this whole conversation to me, was I was taking a look at what stocks were moving sharply today. So if we go over to, this is basically tracks the biggest movers. And one of the things that I saw was Masco in here as up really sharply. And that struck me as interesting because we've seen some home builders, Lennar and other names like this, that aren't necessarily doing spectacularly well, but this is a building materials company. So I was kind of pleased to see that one doing well. That meant their earnings were good. CarMax was not one of the ones that was necessarily doing great on the earnings side. On the sales side, they did okay, but on the earnings side, not so great. Now, the interesting thing, of course, about CarMax is that even before we came into all of this, some of the things that we have been seeing were, number one, that we had been anticipating further rate cuts, and the pace of rate cuts was slowing. We were starting to see some other inflationary pressure, concerns about delays on the Fed continuing what had originally been expected to be a series of cuts throughout the year. Add to that we were seeing considerable number of auto loan delinquencies, so that was sort of a concern in that area. Just a stretched consumer, that would certainly be an issue over there. The other thing is that in that context of Masco, just take a look over here. So you've got D.R. Horton. D.R. Horton is a home builder, and Masco is building supplies. And I found this to be interesting because we've got a little bit of a dichotomy here. We had a negative sales print from D.R. Horton, but we got a positive one from Masco, and this is a pretty big revenue beat, right, over the anticipated number, 4.5%, and that helps explain why the stock is up as much as it is. Okay, so now let's just take a look at some of the other names that have been reporting that we had been looking at. So some of the ones that I had highlighted in my initial post, Boeing, and actually we got Finwest here. Good morning, Mike. Am I correct? The actual earnings numbers have been good, but company guidance has been more important this season over past quarters and thus has affected the market reaction more. I think I absolutely agree with this. And the reason is that we had this marked shift in the backdrop for a lot of these businesses that has taken place that would not have been fully digested for the quarter. So just as a little bit of background, I calculated that the average price for crude oil since February 28th is about $30. I'm looking at Brent, about $30 a barrel higher since February 28th as it was from the beginning of the year through February 28th. So one of the things we did see was that oil prices were ramping, and they were ramping pretty steeply, actually, even ahead of this, off of the mid-December lows. But the impact of that was not going to be felt for the entirety of the quarter. So the quarter that's being reported now would not have embedded those higher oil costs. Not just that, what's going on here has more of an impact than just the increase in prices. There is a consumer sentiment issue. There is a business sentiment issue. How do people feel about, what's going on geopolitically, and is that going to impact their business decision making? For example, are you going to hire as aggressively as you had intended to if you know that there's a war going on, if you know that oil prices are substantially higher? Those things could all potentially be concerns. If it's causing the market to wash out a little bit, how wealthy do people feel? That can affect things like consumer spending. Then you have actual consumer actions that are directly related to it. So, for example, if people were in the Middle East, do they want to remain there while this is going on? Many obviously wanted to leave. If you were thinking about traveling to Dubai, are you going to do that still with what's going on? The answer is a lot of people who had planned to probably decided not to. If you were thinking about buying a new car, maybe you were thinking about buying a new Cadillac Escalade, doesn't get very good gas mileage. Suddenly you go to the pump and you see that premium is $6 plus a gallon, closing on $7, I guess is about where it got to around here. I'm not sure, I didn't check today. Suddenly a gas guzzler doesn't seem so appealing. So either you hold off or you get something else. So there's a lot of cross currents that go on in an environment like this. And so one of the ways that people try to distill that, and I encourage folks to do this, listen to the conference calls and see what management has to say, because almost assuredly they'll make some comments about it. Probably don't want to run, people don't want to get too deep into these issues. There's rarely a real benefit in doing that. Plus, there's a lot of uncertainty that goes on around it. But it is fair to say that there are material implications, and they're going to address those. So Boeing, I think, is pretty interesting because this is this name I think has done pretty well since. So let's just take a quick look at how they have done over the course of the last 60 trading days, and we can see that they obviously had a big hard bounce off of. Let's see, how much are they up now? Because they're not back to where they were even in January. Whereas the market's at all-time highs, they have not quite gotten back. Up 23% off the lows. That by itself is pretty interesting. And let's see where vol is here. So now we have the print. Stock is up. I think, in situations like this, what you want to try to take advantage of, if you still have some, the news is behind you now. So that at least that portion of the uncertainty is resolved. In Boeing's case, it's important to remember that the company, and I apologize, I'm just logging into something on the other side, which I'm going to drag over, bring over the options play here. In some of these cases, what you're going to see is you get these big gaps and implied volatility, which may have been slightly elevated anyway, doesn't come in that hard. But now you have more information. So would I rather sell a 45-day put in Boeing now that some of this uncertainty is seemingly behind us? Certainly the uncertainty of the last earnings quarter and the look ahead. Plus, in a case like Boeing, it's really about the order book. So what you're really hoping for is the situation going to avoid becoming significantly worse? And if people get to that place where they sort of think that that's true, then that's an opportunity to try to collect a little bit of yield, maybe enter into the stock at a slightly lower price, take advantage of the fact that there is still a slight bid for volatility. Conveniently enough, you can see that the 6-month forecast here in options play is mildly bullish, and the 1 month is bullish. So if we're looking for an options income strategy, if you own the stock off of this bounce, you could look to start selling some covered calls. I might probably look to wait until the stock at least got back to its highs in the year, and we could see that that's still a little bit higher. But if you're not in this stock and you're thinking you wouldn't mind getting into it and collecting a little bit of yield in the meantime, then an alternative to that would be just to look out and find something in the, we've got 37s and 57s. I'm going to go out to the 57. That's where we defaulted to anyway. Well, let's look at that as a potential place to sell some puts potentially. See if we can't get a decent yield out of this. That's 230. Maybe give myself a little bit. Look for a 30 delta option thereabouts. So that could be either the 215s, 220s. I think either of these would suffice. We like the stock, so that's fine. 723 a share over the strike price, 220. We've got 70% probability of profit or thereabouts, and we're getting 3.3% over the course of 57 days. So that works out to about 21% annualized. I haven't actually mentioned this in a little while. So that will be a potential trade in Boeing. Something I used to discuss all the time on some of these short premium trades was what I thought an appropriate yield would be when looking at things like cash secured puts, trades like this one. And the answer is that, to me, if you're going to sell cash secured puts, which is taking a form of long equity risk, so it's not long equity exposure in the same way that buying the stock is, because if I have long equity exposure, I get all of the upside and I get all of the downside. If I sell a cash secured put, I do not get all of the upside and I get most of the downside. And so in order for that to be appealing, I want to make sure of two things. One is that I'm interested in purchasing the stock at the level to which it could be put to me net of the premium I collect. And two, I want that annualized rate of return to be consistent with the types of returns that an investor might normally expect if you're going to take equity-like exposure. In this case, this trade, 3.3%, works out to about 21% annualized. If we think of equities as generating, and probably since 1990 it's been close to 12%, say 12% annualized total returns for equities on average over the period, about 1% a month, this would fit the bill because our annualized rate of return is 21%. If it was 5%, 6%, am I interested in selling cash secured puts, even on companies that I like, to get a 5 or a 6% annualized yield? I don't really think it's worth it to do it in that circumstance. So that's usually the benchmark that I have in my mind. And another important consideration is that it's not going to be exactly the same for every company. So Berkshire Hathaway, the amount of money that I would be willing to sell, to sell puts in that is going to be substantially less than it would in a company like Tesla. Berkshire Hathaway has hundreds of billions of dollars in cash on their balance sheet. So, it's basically completely unlevered, 40+% cash. Cash is not very volatile. The risk of having cash put to me is basically trading. One way to think about it is that if you sell puts on a company like Berkshire Hathaway, let's say you have $100,000 and you sell 100,000 notional puts against Berkshire Hathaway, well, Berkshire Hathaway is, call it 45% cash anyway. So really what I'm doing is I'm going to take $100,000 in cash and I'm going to end up with $45,000 in cash and $55,000 worth of all of their other businesses. And presumably I'm doing that at a discount. So depending on how far down I get the stock, maybe it's almost close to 50-50. So you'd be comfortable collecting a smaller amount to do something like that. But I do think that as a starting point, as you think about it, 12% is probably a good place to start as any. Okay. Moving on. Oh, another name I thought that was kind of interesting, because this is a company that really, once upon a time, Wall Street darling, much more recently it has been anything but, and that is 3M. So you can kind of see what the miserable story was here. And this is just 1 year. Let's go back a little bit more because, yeah. So over the course of, how much are we off now, the highs? I want to give this some longer term context, but I thought this was kind of interesting. So it's now off 16%. It did, I think, or I thought it had gotten into formal, did it? I thought it got into formal bear market territory. Did it? No, did it just miss? Not 100% sure. That's got down 19% on it. But this is definitely another, this is a broadly held stock. And I just thought it was kind of interesting. We're below the long-term averages. It had been sort of this topsy-turvy ride that it's had over the course of the last year. Not so great. But this was kind of the thing I wanted everybody to focus on that I thought was kind of interesting coming out of this. And that is that if you take a look at the best performing technical indicators for M over the course of the last year, all of them basically, other than RSI. RSI basically saying, oh yeah, you want to own this thing because it's oversold. Maybe for a bounce, but otherwise it does seem like the news is fairly grim. Now, we should also take a quick peek at the implied volatility as we look at this. If you hold it, and you're saying, if this thing is now oversold, and I want to hang on to it here, but you also are recognizing that on another strong day, this thing is behaving badly, that all of the technical indicators are weak, how might you play that? If you are long the stock, you could hedge it, or if you want to press a short. Certainly, if you're going to press a short, you would want to use a put spread or something like that in an oversold condition, because what does an oversold condition suggest? That you could get a short-term rebound. So what's the play? We can look at it. Well, here's the one that options play sort of pre-populated, so we can probably start with that. It's fine. But I would probably lean a little bit shorter on this if I was going to use a put spread. This one is selected in the money strikes. Here too, that's taking a little too much short delta given the RSI. And what I mean by that is you can trade a put spread that has no theta at all. Actually, let's mock up an example of that. So I'm going to do two of these side by side. All right, so I'm going to come up with, so let's take a look. Let's just say we're going to look at a 135 put on the short side, which is about 260 to the midpoint. So now I'm going to just take a quick look at the calls that are about similar amount, 155. Okay. So if I choose a 155 put and sell a 135 put, these have roughly the same amount of extrinsic premium, meaning that there should be little to no decay in the trade. Meaning that if I put the trade on a standstill basis, right here, right now, I'm not really going to make or lose much money. Now, in this particular case, we end up with, so you have a 50.6% probability of profit by this analysis. You're paying $9.54 for the trade. Now, as you think about it, you take the long strike, which is 155, deduct the short strike, which is 145, that's $10, and then deduct the difference that you are, actually it's 145.78. So 155, 145.78. So the intrinsic value of this trade is $9.22, and you're going to spend $9.54 for it, which means that the amount of actual decay is just 32 cents, which, let's be honest, on a $146 stock or so, that's 22 basis points. This is de minimis, right? So we would think of this as, so when you move these strikes around, that's one of the things that you can think about. How much am I actually paying an extrinsic premium? When options play chooses an in-the-money put strike, you're improving your probability of profit and you're reducing your decay. But you're increasing your delta. And that is because you are trading an option that is in the money. And an option that is in the money is going to have higher delta than one that is out of the money. And in this particular case, because the stock is possibly a little bit oversold near term, I would actually select a strike that is out of the money. So that could be something like, if you wanted to be really tight to the strike, tight to the stock price, you could use something like the 145s. And if we're just going to use it like the 145.35s, that's what we were looking at here a second ago. Then you would end up instead with something that looks a little bit like this, right? So not spending the $9, and that's just because I want to take the delta out. So getting a better than 2-to-1 payoff if it continues lower, and it doesn't have to go that much lower in the grand scheme of things. I mean, we're only talking about 7% basically, the current stock price. So that would be a way to potentially play that one. Netflix, I think we talked about this on an earlier episode. I'm not sure if we completely resolved it. Here's where I'm at. First of all, to his credit, Carter Worth believed that this thing was going to disappoint coming out of earnings. And let's take a quick peek at how it did. We actually talked about it on Fast Money. So this is where we're at right now. My guess is he would not be a buyer, but he might be inclined to take his profits on the winning trade. But basically, he was saying short it into the print. Obviously, very good call. And you probably can't even see it as well there, but you might see it a little better if I just go in like this. You get a sense of how we're doing. Stock's off 13.5%. To me, though, from a fundamental point of view, I still think, I've often said, I like their pace of growth has slowed, but it's still better than the broad market. Unregulated kind of utility characteristic, best of breed. Glad they didn't chase Warner. To me, this is another one. So, people are going to look. That's what makes a market, they'll say. Where did I put my options play? There it is. This is another one where I would be inclined to, if you're not in it, think about doing something like a cash covered put to work your way into a position lower. If you are in it, now that the news has come out, you're sort of in this pair of twos situation. One thing you could consider is, I don't know if you're the type to potentially add a little bit more to a position or not. One thing you could do is layer in a 1x2 call spread, because it's likely to bump its head up against the long-term moving average. And where was that? Let me just double check this. So we're looking at, call it up $100 at par, right? So you could do a little bit of a stock recovery play in here. And the way that works, that's when you're looking at putting on one of these 1x2s. So that's going to look a little something like that. Okay? We're just expecting that the stock's going to probably bump into a little bit of resistance at that long-term trend line. In our case, we're using the 150. So you're giving yourself a little bit of an incremental boost between the current stock price and 100 between now and June expiration. And you're going to pay effectively very little for it. Now, just to let everybody illustrate and see how that is, I'm buying one of the June 94 calls for $435, and I'm selling two of the June par calls for $210 or $420 combined. So net, that's a 15-cent outlay. Obviously, once again, kind of like that other trade that we were talking about when we were looking at the extrinsic premium in the money Boeing put spread. The amount of actual premium you're spending here is de minimis. Now, can one do this without the stock? You can. Because I rather like Netflix fundamentally, not crazy about the idea of taking the risk to get short it, which, by the way, is what would happen, because otherwise this is what the trade looks like. I'll just take the stock out. This will help illustrate. So basically, it would achieve peak profits at... Stop doing that. It would achieve peak profits over here at the long-term trend line. That's the short call strike. It's going to make money between 94 and 106, give or take. We're trading it pretty close to even. But I'm not enamored of the idea of taking the risk of being short the stock at 106. But for those who are a little bit more thrill-seeking, that could potentially be a way to target it. To me, that would be a little bit about threading the needle, though. Really, I like it as an overlay, just a way to get a little bit of an extra boost if the stock should recover back, get a portion back of what it lost following earnings. Okay. Up next, oh gosh, the STZ. Yeah, what we got here? Yeah, the thing about Constellation Brands, and I'm sure many of you watching know this already, one of the most stable sort of core holdings businesses, certainly this was true, when I first got into the business. We never really thought of this as a business that would ever do anything but, probably maintain or grow with the population, and that's the liquor business. Constellation Brands, this is an alcohol company. For those that don't know, they sell Modelo. Modelo took over, at least in the United States, as the number one, the most popular beer after Budweiser ran into some trouble a little while back with Bud Light sales. So they had brought in an influencer. That influencer was not well received in all quarters. And on top of all of that, the person who was in charge of the Bud Light brand, was making some comments that were, arguably a little bit disparaging to their sort of core customer base. And it provoked a backlash, and that backlash led to a decline in sales. And Modelo, which Constellation Brands owns, became the number one brand. Now, what's interesting about this is that that's partially a licensing arrangement because as part of some deals that went on, Modelo is not necessarily... These brands do not necessarily represent the same thing in other countries that they do in the United States for reasons of antitrust and stuff like that. But the short version is they have High West, which is a liquor brand. They've got Corona. They've got Modelo. And the real problem that we've been seeing with these companies is that they have not really been keeping pace with economic growth. They have not even been keeping pace with population growth. And as we can see here, the forecast for revenues for the 12 months ended end of February of 2028, just shy of $9.3 billion. We have to go back in time here. And $9.3 billion in 2028 is not going to be the same thing as $9.4 billion in 2023. It's probably going to be closer to the 8.8 that you saw in 2022. So not great in terms of the growth picture. Blame edible gummies, and you can choose whatever you want, a more health-conscious consumer. For whatever reason, for a host of reasons, it seems like younger people do not drink as much as their elder generations did. And that is having a pretty nasty impact on these as a business. So, what to do here? Now, the one thing about these companies is that whatever situation they're in, let's go back a little bit longer. They're not high volatility, which is a good thing. The other thing I would say about them is that they are now starting to trade quite cheap. Quite cheap. So this thing is trading, what do we figure out here? So what is it, 11, 10 bucks a share? 12.5 a share is what it's expected to make for the fiscal year ended in February of 2028. Could this thing catch a bid? My inclination in a situation like this, it doesn't really have the growth that I would look for to add as a core holding on the long side. If you're inclined to make a bullish bet on that multiple story, thinking, well, maybe it finds its footing, maybe it bounces off that long-term trend line, I'm willing to play it because it's cheap. You want to manage your risk in a situation like that. So this is one of those cases where I'm going to actually instead highlight a trade which I don't recommend very often in most stocks, but that would be actually a call spread. And this is the one that Options Play came up with by default. In the money, this is not bad. We'll call it about $6 for a $20 spread. Maybe that's probably not a bad place to be. I don't know that I would actually tweak this one very much. I think I'd probably just stick with it. So, yeah, you want to play this thing. It is above the long-term moving average. It is trading at a cheap multiple. It does look like they're going to resume a little bit of adjusted EPS growth. It's not a grower. It's not one to get super excited about. But want to throw a couple bucks at it, this would be one way to do that. This trade, by the way, is $1.82 in the money. So that means that you're looking at $4.30 worth of decay over just short of 2 months, which is 2.74% of the current stock price. So you're risking 2.74% of the current stock price in decay, and $6.12 total, or just shy of 4%, to make a bullish bet over the course of the next couple of months. Okay, and if it seems like I'm kind of blowing through these things, one of the reasons I'm doing that is I love to yammer on. Few sound sweeter to me than that of my own voice, I often say. But I did mention some specific stocks, so I just wanted to make sure we get through those. All right. Another name that I mentioned, Alcoa. Let's have a quick peek at the charts and the fundamentals. And then we'll look at the options. All right. So, first things first. Chart. Looks pretty good. Go back a little bit more. If there's anything wrong with this chart at all, the only thing I could suggest is that it's pretty far above this trend line. So if we go back here, it has happened. It has extended more above this than it has done at the moment. Energy intensive business, by the way, manufacturing aluminum. So it is sensitive. Here, too, I would be inclined to use a call spread. And this is really what we're looking forward to here. Full year anticipated growth, but it's not really that big a grower overall. It's a pretty lumpy business, this, right? But trading at quite an attractive multiple, just 10 times, a little more maybe, 11. So kind of the same story as Constellation in that sense. And here too, we'll just take a look at what this one came up with by default. This one is again using an in-the-money option. $3.50 in the money, and you're going to be spending just about $3 extrinsic in premium. Not bad for a name like this. So once again, pretty easy. I think this is not a bad way to play a potential bullish bet. Let's see, it's a 21 delta call. Yeah. I mean, when you're manipulating the call strikes on the short side here, a quick thing that you can ask yourself, say, well, would I pull it, just seeing that it was looking like it was pretty extended above that long-term trend line, might I bring that short call in just a little bit, collect a little bit more premium, reduce the outlay? Here's the question I would ask you, and it's one I ask myself when I look at trades like this, which is, would I sell the 80-85 June call spread for 90 cents? And if the answer to that is no, then you would rather have the 85s as your short, right? Because that's really what you're doing. You're saying, okay, imagine no position. I'd rather sell the 80 and be long the 85, or the other way around. So 90 cents. So you know what? We're going to stick with that one. So that works out to, like I say, about $6.50, a little bit more in premium to press the bet. So I just thought it was kind of an interesting way to take a look at some stocks post-earnings. Because I've said this more than once, I will keep saying it, which is that we rarely know less about a company than we do right before they report earnings. And it is immediately following earnings that you're probably about as up to date on the information that the company can provide to its investors as you will ever be. Just hearing the comments, and I encourage everybody who is interested in these or any other companies, make sure you listen to the conference calls. But the conference calls for these will all be available on their websites, and they're usually recorded for posterity. All right, so okay. Now, So Alex V, you're talking about ServiceNow. Okay. Let's take a look at this company just for purposes of illustration. This is in that basket of stocks that we're already just getting utterly slayed. And yeah, the earnings did little to provide much consolation. In fact, I think this is, I'm going to double check this, but I believe, I'm going to double check here. So this chart isn't going to look probably not a whole lot different than this one. Let's see. No, it doesn't. Actually, looks worse, but these two rhyme, don't they? What is IGV? IGV is the software and services area. This has rebounded sharply, but you know, one of the things is that this is going to incorporate companies like Microsoft, which I feel like has a little bit of, there's a little bit more of a moat around Microsoft than there is around some of these other businesses. Not to mention the very threat to software and services that artificial intelligence theoretically represents. Microsoft has its fingers in those pies too, both on the data center side, as well as some of the investments that they've made. So I think that's an important thing to consider. But yes, to your point, Alex, ServiceNow for sure, definitely an issue. Earnings are sure to help NASDAQ and the Qs, but at this run rate, how sustainable is this? Says seven-figure mission. Some of the earnings, I think, are not sustainable. And even in companies that I like, that we own, that are just absolutely crushing it, and where the near-term demand remains well and fully intact, and it's influencing everything. And I'm talking about things like DRAM pricing. So the Micron technologies of the world. But this is not sustainable from a fundamental point of view. You are not going to see 200% year-on-year revenue growth and 61% net of income taxes, adjusted net income margins going forward indefinitely. This has historically been a cyclical business. It's a commodity business, and right now it is trading as if, they're selling tickets to the Fountain of Youth. That's not sustainable. And I like the company. I like what they're doing. It was actually one of the names that I was promoting not that long ago. But people should not look at this and say, "Oh my goodness, this is a company that for the fiscal year ended mid-2027 is going to do $100 a share." It's trading less than 5 times fiscal 2027, which is really half 26, half 27. That's really the coming year because of the way their fiscal year aligns with the calendar. Trading less than 5 times earnings. Yeah, well, that's because those earnings are not sustainable. That's not going to happen. But it is a remarkable and an interesting story. How long can this go on? Well, it can go on for as long as those that are writing the checks can afford to keep doing that. And that actually is the interesting part, because those that are writing the checks, Oracle excluded, amongst the big spenders, in my opinion, can afford to do so quite handily. Why? Because who are they? They are Meta. What does Meta's cash flow situation look like? I mean, their cash for operations for the last fiscal year, $116 billion. How about Microsoft? How much money they got to spend on this stuff? How about a lot? $160 billion in operating cash from operations for the fiscal year ended 2025. How about, I don't know, maybe an Alphabet, $165 billion. There is a tremendous, amongst those that are doing the big spending, they can largely afford it. And I mentioned Oracle because they want to be a player in the space. I get it. Why wouldn't they be? But here's the situation. $23.5 billion in cash flow from operations is, for almost any business, a phenomenal number. But in Oracle's case, if you want to keep up with the other big players, that is not enough. You got guys out there, they're spending $100 billion a year, right? So what does that mean? That means you're borrowing, and you are borrowing a lot. You can figure out the net debt. They've got a lot of cash on their balance sheet. That's not a short-term liquidity problem. They could always stop spending. But as we speak, or as of their most recently reported quarter, their net debt, which is, you take into account the debt that they have, any sort of hybrid securities that they've got, how much cash they have on their balance sheet. You net all those things out, and what do you end up with? What you end up with is $130 billion. $130 billion in net debt. So this is an outfit where this bet really needs to pay off. Let's go back. We're just going to compare and contrast these two things for just a second to really drive this point home. Right? If Alphabet screws this up, whoops, if I screw this up, if Alphabet screws this up, and this whole thing is a big old waste of time, right? And look at that huge, huge number. $181 billion in CapEx, okay? They're still going to have some net free cash flow because they're probably looking at like $200 billion in operating free cash flow anticipated for the full year. If this is a total waste, what that means is they're like, we blew a year's worth. We blew a year's worth of free cash flow, or 11 months worth. But in Oracle's case, they will, even as we speak, it is more than 5 times their cash from operations. And if that doesn't start generating something, that $130 billion in debt, and I say 130 because I'm netting out the 40 billion here and then putting these preferreds into this bucket, that's still got to be repaid. That's so I don't mind a business borrowing money to try to go into the right area. But I will say that this is one where you have to beware, right? This is the level you're going to want to keep an eye on. Can it break above this downtrend line? And if it does, it's probably going to be on the back of some news. And what would that news be? Well, earnings in June would be one of them. It could break out ahead of that, I suppose. And we can see in the upper right-hand chart, by the way, this is this is the estimates and comps. So it's not like their earnings aren't growing. The company has, a long and successful operating track record. Blackmuck video. They can always stop spending. Not if they want to keep up with the Joneses, because others can afford it. I mean, that is kind of one way to think about it. Keeping up with the Joneses. Jonesing for AI, I guess. But the difference is also that Alphabet has net cash. They do not, if this all proves to be for naught, it's not like they have some massive pile of debt. They're going to have to figure out a different way to repay. So if you look at a name like Oracle and you say, boy, this thing is down so much, I would say that's fine. You're getting a levered bet. But boy, it has to really pay off, because otherwise they're going to be facing that for some period of time. Finwest says, post-earnings is when Carter likes to put on a position. 100% agree. there's almost nothing that anybody that I deal with on a regular basis that says, when I'd really try to take a punter on a company is right before they report. That's partially because it just feels like a coin toss. I will say, this is one of the reasons why I gave kudos to Dan Weiskopf and Michael Venuto. Dan Weiskopf, senior portfolio manager at Title, and Mike Venuto is the CIO. And the reason I give kudos to them is because they were already short Restoration Hardware. They were already short Nike, and they pressed those shorts going into the earnings prints. And I thought that was, it took some guts because those trades were already up a lot of money. And Nike rolled over, I think, another 15% immediately following, and Restoration like 21, 22%, something like that. So, anyway. Tucker D. Dog, I like the up-tempo. I'm being forced by my own post. I had to cover those stocks. Okay, so let's see. Where are we? Ooh, I was speaking on so many different topics, I didn't realize I'd chewed up the clock quite as much as that. There was something else I wanted to do. I was thinking about it right before we went live. What was it? Probably the Strait. Probably the Strait of Hormuz that I wanted to bring up. And let me I am logged in. Okay, I wanted to make sure I'm logged in because this thing, if you haven't gone to this website, I think you'll like it. If you care about what's going on in shipping anywhere in the world, marinetraffic.com. What you're seeing right here is not a paid version. You have to be logged in, though, because I have done this. I pulled up the website and didn't realize I wasn't logged in. I'm like, where's the refresh button? This is the refresh button over here. And this is actually going to be, this is a countdown clock. So if I remember correctly how this works, this says 5 minutes now, and it's going to go down to 4, 3, 2, 1 eventually, and it's going to refresh. Now, of course, what we want to be seeing is a lot of traffic in here. That's what we want to see. That shipping lane to be nice and full. It's not what we see. So, unfortunately, this issue persists. If you want more information, and I'm going to just specify this, you go to Marine Traffic. Once you set up a user ID on the Marine Traffic website, you also are going to want to make sure that you check out the news section, same thing that they have, because they will give you, they have been running this really great update. And they have a daily update of what's been transiting and what the actual attacks have been. And this is the part that I'm going to draw your attention to right here, which is, so for a while, we hadn't seen any verified attacks. And now we've had one. Or 2 or 3, right? Which is the one, so the, I'm not, and you can kind of see what's happening to the, this is another way to look at the traffic. I thought we had punched some inert shells through the engine room of an Iranian ship, but I guess that doesn't count here because I'm not seeing it on this list. This, I don't know which that was. Maybe someone can refresh my memory. Oh, here it is. No. So that was approaching the strait, I thought. I'm not sure which one of these it is. In any case, go to the website. Great way to, find your way around. You can hover over each of these. This is the region that matters. I can probably just refresh this. What the heck? So I just refreshed it right now. Oh, we got one here. What's this? I don't think that was showing a second ago. General cargo. Kind of more interested in the tankers, yeah? What's this? Yeah. So, yeah, this is what we've got to keep our eyes on. The other thing I'm just going to say about these open mic videos, and this is particularly important for those who are watching it as a live on X, and that is that you have to schedule those ahead of time. And if you do schedule them ahead of time, they just give a hard out when we're done. So one of the things you're probably going to find is that as the final hour approaches, so closer to 2:15, I'm going to start wrapping this thing up well ahead of that so that I don't just get cut off midway. Let me just take a quick look here. Let's see. Historic barriers to entry, build a factory, but then you have it. AI, more like it. You have built a new factory every other day. You know, this is another, I'm glad you bring this up. There's one other thing, and I haven't completely come to a conclusion about this, but I will say that the pure data center plays, I'm not as enamored of those as some are. I know that there is a logic that says, oh, I want to be in the plumbing of this industry, in the plumbing of this business, or I want to be in the picks and shovels of this business. And I get all of that because at its core, it sounds a little bit like if you're going to mine for gold, you've got to have the hardware to dig into the rock. But I'm not 100% sure that I feel that way. If some of this stuff goes in the wrong direction, I think about it a little bit more the way I do things like, and I mentioned this yesterday on Office Hours, for those who didn't see it. You have this problem where it is not as if once you've built a data center that is now set and forget. That electronics degrade over the course of the time, and they certainly become outdated. And that's going to require reinvestment. And so it is not simply that the business and demands on those data centers will be such that you identify, find customers, and get all of that going. This is not a one-time thing, the capital that's getting thrown at these businesses. Its pace may slow a bit, but it is going to be recurring. And so as people are trying to discount those businesses, bear in mind that today's GPU is not going to matter 5 years from now. And so everything that's in there is going to be put in the bin, and something else is going to have to replace it. And when you look at it that way, you think, well, where does it all end? It's not like there's this magic light at the end of the tunnel, after which time, now I have it. I've built it. And it's just like a money printing machine that I can just run indefinitely. So I would just exercise a little bit of caution in that space. That is probably as good a place as any to end it. We are going to keep our eye on more earnings because although I think more than 100 names in the Russell 1000 is a reasonable sample, we've gotten some sense for what's going on. That still means that almost 90% of the large cap have yet to report. And so there will be a lot to report on because of that. And so that's what we're going to be doing the next time we have an open mic, and I hope you join us for it. And if you can, also join me tomorrow for my Codown live stream, which I'm going to post to this same channel, and also will be on the YieldMax ETFs X account and YouTube channel as well. So until then, thank you very much for watching, and we'll see you soon.